Every year, families file life insurance claims and discover too late that a small mistake their loved one made years ago just cost them tens of thousands of dollars. Not because of fraud, not because of fine print designed to trick them, because of 7 completely avoidable errors that nobody warned them about. Today, we're going through all 7. And yes, mistake number 4 is sitting inside the majority of policies right now, including probably yours. This is Policywise, insurance explained honestly. First, some context. Life insurance is one of the few financial products where the consequences of getting it wrong aren't felt until after you're gone. You can't call your broker from beyond the grave. The people who suffer the fallout are the ones you were trying to protect. So while some of these mistakes feel minor, the downstream cost can be staggering. Delayed payouts, reduced benefits, or in the worst cases, a full denial. Let's go through them one by one. Mistake number 1, failing to name a beneficiary, or naming the wrong one. You'd be surprised how many people buy a policy, pay premiums for 20 years, and leave the beneficiary line blank. When that happens, the payout usually goes to the estate, gets tangled in probate court, and takes a year or more to reach your family, with legal fees eating a slice of it. And then there's the wrong beneficiary problem. Naming your estate instead of a person. Naming an ex-spouse you forgot to update after a divorce. Naming a minor child directly. In many places, insurance companies can't pay a lump sum directly to a child, so the money gets frozen until a court appoints a guardian. The fix is easy. Check your beneficiary designations today, not next year, today. Mistake number 2, picking a number because it sounds about right. If you watched our last episode, you know the dime formula. But millions of people just pick $250,000 because it feels big enough and move on. Fast forward, their family has a mortgage, 2 kids, and lost income. The $250K runs out in 3 years. Under-insuring is the most common and most expensive mistake on this list. When you're shopping, do the actual math. Mistake number 3, waiting. Every year you delay buying term life insurance, your premium goes up, because every birthday makes you statistically riskier to insure. A healthy 25-year-old might pay, say, $18 a month for a 30-year, $500,000 term policy. The same person at 40 might pay 2 to 3 times more for the same coverage. The difference adds up to tens of thousands of dollars in extra premiums over the life of the policy. Youth is the only discount that can't be bought back. And here it is, the one hiding in almost every policy. It's called misrepresentation, and it doesn't always happen on purpose. When you apply for life insurance, you answer a health questionnaire. Most people answer honestly, mostly, but then they leave out the thing they're embarrassed about. A mental health diagnosis, a few years of smoking they tried to hide, the sleep apnea they were diagnosed with but never treated, a skydiving habit, occasionally alcohol use.
Here's the risk. In most jurisdictions, life insurers have a contestability window, typically the first 2 years of a policy. If you die within that window, the insurer will investigate. If they find that you omitted something material, something that might have changed your premium or your eligibility, they can reduce your payout or deny the claim entirely. Even after that window closes, a claim involving misrepresentation can still be challenged for fraud. The safest path? Answer every question completely. If your honest answers raise your premium, shop around for a better rate. Don't hide things. The people who pay the price won't be you. Mistake number 5, buying a policy and treating it like a set-it-and-forget-it appliance. Your policy needs a review anytime your life changes significantly. Got married? Had a kid? Bought a house? Got divorced? Received an inheritance? Started a business with partners who depend on your key person value? Each of these events changes how much coverage you need and who should receive it. A good rule: review your policy every 2 to 3 years, or after any major life event. Mistake number 6, treating your employer's group life insurance as your actual plan. Most employer policies cover 1 to 2 times your annual salary. That's a starting point, not a finish line. And here's the kicker: it disappears the moment you leave that job, whether you quit, get laid off, or retire. If you develop a health condition while you're covered by group insurance and then lose that job, you may find it significantly harder or more expensive to buy individual coverage. We're doing a whole episode on this one. It's that important. Mistake number 7, picking solely on price. Not all life insurance companies are equal. Financial strength ratings from agencies like AM Best or Moody's measure whether an insurer will actually be able to pay your claim 20 years from now. A policy from a financially shaky company that charges slightly less is not a bargain. Check the ratings. Look for at least an A- or better from at least one major rating agency. Let's talk about who each of these mistakes hits hardest. If you're in your 20s and single, mistake 3 is for you. Buying early is the cheapest thing you can do for your future self. New parents, mistake 1 and 2 are your biggest risks right now. Update those beneficiaries. Do the dime math. Homeowners, mistakes 5 and 6. If your mortgage just got bigger and you changed jobs, your coverage picture has changed. Self-employed and freelancers, you don't have a fallback employer policy. Mistake 6 doesn't apply to you because you never had the false safety net to begin with. Make sure you have individual coverage. Retirees and near retirees. Mistake 7. You may have held a policy for decades. Check that your insurer still carries strong financial ratings. 7 mistakes. Wrong or missing beneficiary, under-insuring, waiting too long to buy, misrepresentation on the application, the big one, not updating after life changes, relying only on employer coverage, and choosing price over financial strength. None of these require expertise to fix. They just require you to actually look at your policy.
Now you know the mistakes. But there's still a big question a lot of viewers ask. Is whole life insurance ever actually worth it? The answer is yes, but only in exactly 3 situations. I walk through all 3 in the next episode. If someone's ever tried to sell you a whole life policy, you'll want to see this. Subscribe for one honest insurance breakdown every week. This is Policywise. General education only, not financial advice. Talk to a licensed professional before you buy.